Hello and welcome to ETF Atlas. My name is Jack Bogle and I'm thrilled to guide you through today's conversation. At ETF Atlas, we host the world's largest ETF database covering funds from the United States, Canada, and Europe. Today, we're joined by Eric Balchunas, a senior ETF analyst at Bloomberg Intelligence and the author of The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. Eric, for our listeners who might not be familiar with you or with your work yet, could you tell us about your journey to becoming actually one of the most respected voices analyzing ETFs, at least when I look on X portal, and also regarding the revolution Jack Bogle initiated. So I think you're the voice number one here. So could you please introduce yourself quickly here?
Yeah, sure. So I look after all the ETF research for Bloomberg Intelligence. It's a team of about 10 people all over the world. And I got into ETFs about 20 years ago. I was in Bloomberg's data group. And prior to that job, I had been a mutual fund reporter. And so having known mutual funds, when I saw the ETF and got introduced to it, I was like, wow, this is going to be pretty big, I think, because it's so much more convenient and cheaper and all this stuff. I felt like I had discovered like the new thing. Anyway, fast forward, I did. I basically hitched my career at that point onto ETFs and did everything I could to learn more and became like the ETF guy within Bloomberg. For about 10 years, I was like a one-man army. And then slowly the company kind of got into ETFs and they asked me to do research. So I moved from data to research and I lead that team now. And that's really how it happened. And I've always been into both writing and economics ever since college. So at this point, I feel like I'm in a job where I use like most of my interests and a lot of my skill set. And so wasn't a perfectly direct route, but it's great. And I always say ETFs are really fun to cover because it's never a dull moment. You know, they cover everything. 4 come out a day. It is really, there's a lot of novelty involved. Even if it is the same job for 20 years, the industry keeps it fresh.
Yeah, sure. So let's start with the elephant in the room. You interviewed actually for your book over 50 people. I mean, the Bogle Effect book, including Jack Bogle himself multiple times and even Warren Buffett. And when you set out to write this book, what were you actually looking to understand? I mean, was it Bogle's biography or were you maybe trying to answer some bigger question about how markets and investing changed?
Yeah, well, I had 3 different interviews with Bogle, which made up 3.5 hours of audio. And I had this dictaphone thing on my desk during COVID and I had a little extra time and he had passed away and I thought, his spirit and a lot of his takes were in that dictaphone. And I felt like it should be put out there in some form. So I called some people, and writing a book's a pain in the ass, to be honest with you. It's a lot of work. You have to really want to like spend a year on the planet of the topic. So did I want to spend a year on Planet Bogle? And I thought, yeah, I do. There's interesting guy, and it's a good place to learn a lot about investing from, right? It's almost like spending a year on Planet Buffett, right? It's like right up there. So I took those 3 hours, transcribed them, and then I started to like write about each area. And we had on Bloomberg, we have a ton of data. So I also wanted to show people how big Vanguard was getting. I mean, Vanguard is unbelievably big. They're probably way bigger than most people think. Like they take in almost $1 billion of new cash a day. And that's for 10 years. So there were some numbers that even my colleagues in Bloomberg Intelligence weren't aware of because Vanguard's a private company. So I wanted to take those 2 things and really get it out there and just sort of like be like, look, this is like as big as Amazon is to retail. That's how big of a deal this whole thing is. The other thing is I felt as though Bogle's impact was underrated in that people just called him the father of passive. But what I noticed is that he also really was the father of low cost. He also changed the way the broker advisory industry operates. He also had a tremendous effect on how active management makes a living now. He also had a huge effect on behavior. I think it's much easier to not trade now. I'll go into why if you want to, but I think he just had these effects. And also the ETF industry, he didn't love ETFs, but it wouldn't be the same without his impact. So I was like, let me actually like try to piece together the effect that this one individual has had in like 5-6 different areas. And this will be a cool way for someone to read it and get really up to speed on like how much the industry is changing that we call funds. And the reason funds are important, I know most people, it's as like interesting as C-SPAN, but the reason mutual funds and ETFs are really important is because they sit in between all the value created by Americans and people around the world, right? Everybody gets up to work at NVIDIA. It's not just the CEO. There's like thousands of employees. They get up to work, they create value, they sell stuff, they make money. And that part of that is given back to the owners, who are the stock investors. Well, most of the people who own it through a fund. So in between all the value created by these companies and Americans and the actual investors who are depending on it for the retirement is the fund industry. So in a way, it is at a crucial place and needs to be watched and looked after. And here's a guy who came in and could have just sort of like been on the take, if you will, and like taken his 1% fees and just become a billionaire and been happy. But he said, no, there's too much money being taken out of this. There's too much being skimmed off the top here. Let me completely revolutionize this industry and then shrink it. And that way the investors get more money. And that is, nobody goes to Wall Street with that in mind. This was like just an oddball mission this guy was on. And so that's the story I wanted to tell. I thought it would resonate with younger people and with anybody really, because I think people just blow off the mutual fund industry as too boring and who cares, but it was really important if you think about it. And this story is, to me, one of the best business stories that I've ever heard.
And for the young people, if they are listening to us, I want to also touch the cryptocurrency later, so please stay with us. And now I wanted to ask you about indexing, because many people think that indexing was actually inevitable, and that eventually someone would have done that, what Bogle did. But actually, once you read your book, it suggests something different. And I wanted to ask you, why was Bogle specifically needed? I mean, what would have been different if maybe he'd never existed?
Yeah, so I do think indexing would have happened. There was a guy who made an index before Bogle. And there was also a article published in the Journal of something in like the 70s that said somebody should create an index fund. That's what gave Bogle the idea. He didn't invent it by hitting his head on the toilet. He saw these early chatter about indexing and what that is. But the reason, Steve Jobs didn't invent the PC, right? But he is the one remembered for bringing it to America, right? Same deal. Why was Bogle remembered? I'll tell you why. Because he created the index fund and he put it out, and it was, the first fee on it was like 55, 60 basis points. So it wasn't cheap. But the genius thing he did was, when Vanguard was formed, he created it with a structure called the mutual ownership structure, which is somewhat how insurance companies are structured, not asset managers. So he took this structure from the insurance world and moved it over to the asset manager world. Still today, the only one structured like this. And to keep it simple, what that means is, if you invest in Vanguard, you don't just own the funds, you own the company. And so when you vote to put people on the board who are going to vote for your needs, so the board is made up of people representing the investors. So of course, when they get extra money, instead of voting to like sponsor a sports stadium or pay the executives more, they vote to lower the fees, because that's who the board is. It's like a group of investors. So what happened was, over the years, as the index fund got more popular, they kept voting to lower the fees. So over 30 years of voting fees down, they get the index fund fees down to under 10 basis points. Now today it's under 5, 3, 2. Some Fidelity has free. And by doing that, that's the big deal. Index fund at 60 basis points isn't that great. Index fund at 3 is. And so really, high cost to low cost was what his big contribution was. And I don't know if any human could do that on their own. I think the mechanical system of Vanguard, the structure and the incentives were set up really nicely, that it made everybody incentivized to lower fees there. And that's still going on today. And that's an advantage that they've always had, because you talk to their competitors over the years, and they'll say stuff like, how are you supposed to compete against the nonprofit? That's sort of what they say. So he built this like slow detonating bomb inside Wall Street that was going to, basically mess up the status quo. And it did. It took 40 years. But ultimately, once the index funds got below 10 basis points, everybody was like going gaga for them. And why wouldn't you? Who doesn't want free exposure to the market? And then everybody else had to change. So BlackRock started coming out with cheap ETFs. Fidelity launched cheap index funds. T. Rowe, all their competitors now have cheap index funds. So it's not just that Bogle and Vanguard did this, it's the effect. So now everybody has cheap index funds or ETFs, and most of the money in America goes to them. And so he changed the whole game by doing that. But I always say if he didn't exist, I bet there would be index funds, and they'd probably be 50 to 70 basis points. So they'd be like maybe 1/50th of as popular. Now you may say, what about a company that came along and offered them for like free as like a loss leader? Okay, maybe a Schwab would have said, let's do this for free, and we'll use it as to bring people in the system, and then we'll try to sell them on other stuff or make money on the interest income from the cash they have lying around. That might have happened, but it would have come, like I said, a free index fund would have come with a catch in any other format. Vanguard, there is no catch. They literally want you to win. And that is so unusual. And that's why it wouldn't have happened like it happened without Bogle. I premise in the book that if he didn't exist, index funds would exist, but they would have, I think I put like maybe 5% of total assets. Right now they have 60%.
What surprised me when I was reading your book was that Bogle actually hadn't even heard of the efficient market hypothesis when he started creating index fund. And so actually his reasoning wasn't purely academic, I would say. I mean, what was his actual reasoning then? I mean, how did he arrive at indexing if not through academic route, most people assume?
When Vanguard was formed, it was formed after a breakup with him and some ex-partners. Anyway, long story short, is part of the breakup, he wasn't allowed to manage money. He could only set up the back office and do the back office work for these active funds. So in a way, the circumstance had him thinking of out-of-the-box solutions because he couldn't run money. And he was kind of bored. You know, he had this back office, Vanguard. It was structured mutually ownership structure. And he read the Portfolio of Management journal. This was, again, back in the, I want to say, late 60s, early 70s. And in that journal entry, this guy, Paul Samuelson, he actually worked in the JFK administration. He was a popular economist. He said, these active managers are overrated. I wish somebody would start an index fund so we could actually have something in the market that we could compare them to. And Bogle read that and said, wait a second, let's run the numbers. Let's see if these index funds are actually good. He ran the numbers and found that they would outperform most of active. And he goes, we should do this. And then when they thought to do it, his partners were like, you can't do it. You can't run money. And he was like, no, we're not running money. It's not, this is, we're just, an index fund isn't actually running money. It's not actively managed. Then he squeezed through that loophole and was able to birth the index fund partially out of necessity and partially out of inspiration from that journal, the trade journal. And that is how he got introduced to it. But Bogle, he didn't know the efficient market hypothesis. He sometimes would play dumb and be like, I'm just this folksy guy. He was smart, okay? He went to Princeton. He knew what it was. But I think the good thing about Bogle was he never got too into the formulas. And he never got too into his own secret sauce. Like a lot of these active managers think they discovered the Holy Grail. He was like, nah, it's all just, there's a lot of just speculation and luck. And so what he came up with was the cost matters hypothesis, because after he came out with index funds and he really saw the potential, he really got into it. He ran all kinds of studies. And what he did is, one of the most brilliant things he did was he would put the savings from an index fund versus an active fund into dollars. So a chart that we highlight early in the book is a chart that he promoted to Americans. Because remember, at the time in the 70s and 80s, active managers were like looked at as gods. And to have an index fund, it seemed average. And in America, we all want to be winner number one. It's all like Top Gun over here. And so people are like, I don't want average. And even Fidelity, their advertisement was like, would you want an average surgeon working on you? It's pretty good, right? So Bogle had to be like, no, it's not average. So he'd show this chart of $10,000 invested in a 60-40 portfolio. With index funds, you get 8% a year. And with active funds, you get 6% a year, because that's the market minus their 2% fees. And over 50 years, with the 8%, you get like 380 grand. And with the 6%, you get something like 150 grand. So you get more than double. Those 2% fees ended up confiscating over 60% of your total returns in 50 years. So he called that the tyranny of compounding costs, eating up the magic of compounding returns. And putting it into dollar terms, and you can see your retirement, you're like, wow, I'd much rather have 350 grand. So that's part of how he was able to put some of these wonky terms into like things anybody could understand. And he saw the efficient market hypothesis as like, a distraction and so he came up with the CMH, which is the cost matters hypothesis. So he was clever enough to work around these scientific formulas. And I think it was smart because it also put him almost like at odds with this sort of like super smart, we know what's best guys. And he was over here saying like, look, I don't know all these fancy formulas, but what I do know is if you have low cost, you'll win in the end. And it resonates.
In your book, you have a chapter titled Bogle and ETFs. It's complicated, and I would say it's one of the most interesting, at least to me. I wanted to ask, why was someone so aligned with passive investing in the end, so skeptical of ETFs, which sounds like, perfect vehicle for cheap passive exposure?
Yeah. Okay, here's why. One, it wasn't his idea. Okay. He was a little bit of an egomaniac, and that was one. However, the guy who started the ETF, Nate Most, visited Bogle 2 years prior to launching SPY and asked them, can we do an ETF on your Vanguard index fund? And Bogle said, no way. And the reason he said no way was he doesn't like trading, and he didn't want his precious index fund put on a stock exchange where you could get in and out every day. He thought that it would be, he called it like handing an arsonist the match. He thought that investors generally are like their worst enemies. Like if they can trade, they will. And he thought an index fund gave him a better chance of not trading because you can only get in and out once a day. So he thought anytime it's on an exchange, it's going to like tempt them to trade. That's all. That's really it. He just doesn't want people to trade. In the end, he could have made more money for Vanguard. That's why he was so weird. He could have done that deal and started Vanguard ETFs. Imagine if SPY was Vanguard. Vanguard would have like 80% of all the ETF assets. So he purposely took these lefts instead of rights that were better for the investor, he thought, than for himself. And that's why his journey is so unique. In this case, though, I think he was a little over extreme in his view of them. Because if you look at ETFs, some are traded a lot, some aren't. And like the Vanguard ones are not traded a lot. People are fine withstanding the temptation. They can buy VOO and not trade it. They can wait 20 years. Advisors in particular are smart enough to know just because I can trade, I won't. So I think in the end, he did relent a little bit. And he thought, well, the Vanguard and some of the other ones like from Schwab, they seem to be pretty good. But still, he was never quite comfortable with it. The metaphor I used was the index mutual fund was like his firstborn daughter. And the ETF was like the tatted up bad boy that she ended up marrying. And so he didn't want this guy in the family, but he had to deal. And that's ultimately the arm's length, the relationship he had with the ETF. In the end, Vanguard launched them after he had stepped down as CEO. They become a huge hit. And I think the Vanguard ETFs did a lot of good for the ETF market. They kept fees low. And now today, VOO is the biggest ETF in the world. And it launched in 2010, which was 15 years after SPY. That's how fast VOO is growing. So in the end, I think the ETFs distributed the Vanguard philosophy and the Vanguard low fees in a much bigger way. And Bogle just, again, I get why he wasn't into them. The one other thing he didn't like was the marketing. Sometimes the ETF marketing is a little over the top. There's some crazy products, like he didn't love the thematic ETFs and the leverage ETFs. And he thought that was all just like a distraction from like real investing. And he has a point. So in the book, I say like his 2 points, like if you can't hold yourself back from trading, then you might want to do a mutual fund. And if you're like tempted by like all whiz bang shiny object stuff, then maybe, he has a point on ETFs. But I think for the most part, 95% of people who like own a Vanguard ETF are Vanguardian in nature. Like they're not going to trade. So I think somewhere in the middle of his warnings and like people saying Bogle was totally wrong is probably the right truth. He had some point, but I think he went too far and over dramatized it.
All right. we are talking about index investing, but also quite often we use the term passive investing. So I wanted to ask, what actually constitutes passive investing? Is passive investing truly passive, or is there some more activity happening than the label suggests?
I would say that like the bulk of the money in passive is pretty passive. But you could argue the S&P 500 is not truly passive. It's only large caps. So you're not you're making a bet that small caps aren't good, I guess. Also, you need to have a couple qualifications as a stock to make it into the S&P. It's not just the 500 largest companies. You have to have positive earnings for 4 straight quarters. Remember, MicroStrategy is a stock that was big enough for a long time, and now it checked off all the boxes, and it still didn't get in because the other reason, there's a committee of humans who basically have final veto power over what gets in, and they vetoed strategy. They vetoed Tesla when Tesla was first available. So the S&P, I would say, is 95% passive, but there's this like active component that some people think is not academically passive. Anyway, but then you get into smart beta, which is like dividend ETFs, which like weight the or screen on how much dividend the stock has. There's fundamentally weighted ETFs. There's equal weighted. There's a plethora of ways to like tweak the index, and yet it's still an index fund. So I would say, for the most part, if you took all the passive assets, I would say 30% is tweaking the index to make it active. I would say 70% is bulk beta. Basically, it's beta, and that's pure passive. So you make a good point. And that's why we try to tell people, like, you know, the other thing I would say is this is like, while some passive has active qualities, a lot of active has passive qualities. If you look, there's this thing called closet indexing where an active manager just holds most of the S&P stocks. And why wouldn't they? You know, if you're the top 10 stock in the S&P, you're probably good, right? So an active probably going to own the same ones. So you look at an active portfolio and you see like Nvidia, Apple, Google, and you're like, why don't I just own the index of this? And so we had this way to put it where we said a lot of people went from closet indexing active to just actual indexing and effectively owning the same stocks for half the cost or even less, maybe a fifth the cost. So that's ultimately this big trend you've seen. But that's why I say people are like, oh, passive is like, just buying the stocks and they're not thinking. I'm like, I'm sorry, why don't you open up an active mutual fund? I guarantee you they own a lot of the same stocks. I mean, you're going to own these good stocks. Now they're going to make small tweaks, but I think for the most part, people over worry about passive on that front.
Yeah, so basically you don't see the problem here that, that we can have a healthy market when so much capital is flowing mechanically into the index funds. Do you think that there are some problems on the horizon?
Yeah, well, not really. I mean, here's when if a stock has earnings and the earnings are bad and the stock doesn't move, that's when I'll be worried. But that doesn't happen. Like, there's earnings, the stock goes up and down. It's fine. I mean, if you look, Nvidia is a good example. I think 6-7 years ago, Nvidia was like the 180th biggest stock in the S&P. Wild, right? Now it's 1 or 2. How'd that happen? Well, yes, passive bought Nvidia 7 years ago, but a very tiny amount every time. Why did Nvidia's price rise up? Well, Active liked it. Active saw the chip industry, saw what they were doing, kept bidding it up. When Active bids it up, the price goes up. When the price goes up, you multiply that by shares out, you get market cap. The market cap goes up. So then if you have a market cap weighted index, you're going to get a bigger weighting. And so GE is another example. GE was the number one weighted stock in the 2000s. And now I think it's 100th or something like that. So Active did not like what they saw with GE. So as long as stocks are going up and down and like changing order, sort of like the Billboard song charts, back in the day, I'm fine with it. I mean, it just shows that Active is deciding what is important and what is good. If that were to be just static, that's when you have to worry. That's my big eye test for this whole thing. That said, I think where passive is potentially, I think what it does is, if a stock is getting bid up like Nvidia, passive can help amplify it a little bit. Because as it gets more bid up by active, here comes passive also buying it. So passive will amplify stocks that active likes. And then if there's a crash in the market, passive inflows are so good and reliable, I think sometimes they can save a stock from going down more like to where it probably should have gone down. So if everybody all of a sudden hates, I don't know, a company like Macy's and active starts dumping it because of some bad, because it's in index funds and they see inflows all the time, it's possible Macy's went down 35% when it probably should have gone down 40 based on active's opinion. Those are the two ways that the flows into passive probably impact that, but it's on the fringes, I think, and I wouldn't worry about it.
Recently, I had here Larry Swedrow, and he mentioned that only about 2% of active managers now generate positive alpha if you take into account fees and taxes. Are we witnessing maybe some functional end of active management as a viable business model, or will active investing find a new form in the end?
Active is very creative. Wall Street's very creative. So active is going to evolve. But this idea of charging like 1% for what is mostly beta, right? If I open up your active fund and I see Apple, Google, Microsoft, the usual suspects, and you're going to charge me 1%, why would I ever buy that? So we have a phrase on the team called beta adjusted fees. So let's say you are that fund. Like DFA is a great example. They're active. I know they're technically smart beta, but let's just say DFA, they have an active fund that has most of those stocks, but they only charge 10 basis points. So like, even though it doesn't have a lot of differentiation from the index, you're not charging a lot either. So it's basically, you have to pick an expense ratio that is cognizant of the fact that beta is free. So if you have a lot of beta in your fund, you got to charge less. Just charge for the active. If you're very different from the index, like ARC or a thematic ETF, you can charge more because you're going to be used more like hot sauce in small allocations, and then people are less fee sensitive. But for the core, if I'm going to put 40% of my money, I need it cheap. And so active has gotten cheap. Capital Group's pretty cheap. And all of these new successful active funds, JP Morgan, they're all under 40 basis points. They charge you just for the active, and they're making their way. On the flip side, there's a lot of people going the completely other direction, like wild and crazy. Thematic ETFs, double leveraged. There's a bunch of high yielding stuff that use derivatives for yield. That's also a form of active. And thematics underrated. They're a good form of active. I would call them kind of hot sauce too. And then there's this new thing called buffers where they like target your downside. So like you can protect yourself on the downside, but you give up some of your upside. It's just an option strategy that they pull off for you that like helps you. It's like a structured product. That's active. And that's an interesting solution for, older investors who have anxiety. It definitely guarantees less downside protection downside protection. So those are all different ways that active has evolved in the Vanguardian era, and it will continue. So the only thing that's really an endangered species is high cost, low active share, the closet indexing active that I talked about. But I will say that they have trillions of dollars. That's a big area. So that's where I think most of the money that's going to passive is coming out of, for sure. All of those funds, by the way, they have more assets than ever because even though they're seeing outflows, the stock market has gone up so much that it's offset their outflows. So in a weird way, even if you're like underperforming and you've seen a ton of customers leave, you might be having a revenue record this year, believe it or not. It's crazy. I call it the bull market subsidy. So don't shed a tear for them. But in the end, I call mirage assets. A lot of these assets are hollow. It's big assets, but it's largely just because the market went up. The customers are gone. And they know this. That's why a lot of the fund companies are doing their best to switch over to the ETF world, which again is very similar to the way the music world switched from compact discs to digital music. You would be an idiot, right, to just put out CDs and vinyl. You got to be on Apple, iTunes, and Spotify, right?
Sure. You've mentioned the term hot sauce, and also I know that you're using another term, boomer candy. Could you explain maybe these categories because they're such vivid terms?
So hot sauce is anything that's really volatile that you would use to sort of like, speculate. So I would put like thematic ETFs in there. So say you have like a cheap core, you get the S&P 500 and like the ag bond, and you pay like 4 bips. You're like, okay, I'm going to marry this thing. I'm never going to break up with it. I'm going to wait 30 years for compounding, but it's boring, right? You got, who wants to wait 30 years and do nothing? So people want to decorate and distract themselves a little. So themes, crypto, ARC, these are things that like you may want to like have a little bit exposure to. so that you don't kick yourself later like, oh, I should have owned a little bit of that. And the one thing about some of these, whether it's crypto or ARK or thematic ETFs, is that they aren't really represented in the big indexes. You have to be a fully grown adult stock to make it into the S&P. Like I said, strategy still isn't even in there. So these themes and these other things help you get some of the toddler and teenagers out there in a strategy you want, or maybe you add a small cap ETF, something like that. So I would call that hot sauces. Could be completing your portfolio or just rank gambling. You could have 10% just to go wild betting on 2x leverage and what have you. Crypto, I think, is a good example of like something people don't want to like hate themselves if it goes up a lot, or they really do believe in currency debasement and want to have a slice for that. So all of these things that can complement cheap beta are organically popular. Boomer candy is the opposite. You've got this core and you like it and it's cheap, but you're worried that like your 60 and your 40 could like all go down because in 2022 stocks and bonds went down together. And so you're like, damn, I don't really have any protection, or I felt unprotected in 2022. So buffers are like, hey, we're going to give you up to 10% of the stock market every year. So you get up to 10% of the upside. But in exchange, we're going to kill the downside. Are you willing to make? Yeah, a lot of boomers are like, hell yeah, I would love to have that. So in a way, those funds, I call them boomer candy because if you're young, who gives a shit if there's downturns? But for boomers, they don't have a lot of time left. So they're like, they want to protect their principal. And so that's why they like pop them like candy. There's also premium income funds that also have anything that has a trade-off where you give up a little upside for some downside protection or income. To me, that's boomer candy. And they're very, very popular for obvious reasons. It's almost like the way a drug would cure anxiety.
You've called the January 2024 approval of spot Bitcoin ETFs a moon landing moment for crypto. And, that's a quite strong language, I would say. What made this approval so significant in your opinion, especially considering it came less than 2 years after the FTX collapse?
Well, exactly, right? I mean, at that time, Bitcoin was trading around 25,000, I think, or 20,000. And it had a stench in the air. Let's be honest. There was a little bit of a feeling that, okay, it's probably just going to go away and stay in this real small niche area. And it was kind of written off a little bit, at least from mainstream people. Remember, people love Tom Brady. He's an American hero. And he told you to buy crypto, and he was made to look a fool. And so investors were real turned off. They were like, I can't believe this guy made everybody look like a fool. And I don't know, it's hard to come back from that. Anyway, the ETF, the BlackRock ETF is filed, and people are like, whoa. Any other issuer, except for Vanguard would have been just as big. But BlackRock filing was like, what? Then ultimately, it turned out they approved them. And when they came out, the reason they're so important is the ETF is cheap. 20, 25 bips is really low fee for Bitcoin exposure compared to other funds in the market at the time. They're liquid. Most of them trade over $100 million, if not billions a day. That means your bid-ask spread, your round trip trading cost is 1 to 2 basis points. Compare that to any of the exchanges. That's a godsend. And number 3, the brand names. And this is major. Nobody wants to worry about their money being stolen by a 29-year-old who dresses like a 12-year-old. Okay? Like, that is not something a normal investor wants to worry about. It's enough worrying whether Bitcoin will go down or not. Okay? I don't have to worry about the money getting stolen, at least. And so BlackRock and Fidelity are trusted. The ETF is trusted. It has the regulatory halo of the SEC over it. And advisors in particular, and just heads up people are like, okay, it's safe now. So that safety and trust issue is major. And so the ETF ends up sitting in between the wild and crazy crypto world, although it's getting better, but the reputation is I could lose my money, and the traditional finance world. And so to me, this was a moment that sort of validated Bitcoin and legitimized it. And if you noticed, ever since the ETFs come out and been successful, a lot of things have happened. The banks are opening up to them. It's more acceptable to be in the plumbing. Governments have bought them in sovereign wealth funds. Corporations have. So this is all, we call them the suit coiners. The suit coiner era is basically unfolding as we see it. And I think that is exactly what was inevitable. When you have something that's very popular, that's on the underground, if it's that good, it's going to find a bigger audience. And so I would just look at it as a compliment that this institutional adoption has been so strong. I know there's some, concern now whether it's too strong. Like, do I really want this like sort of underground, anti-establishment ethos co-opted by Wall Street? And I understand that, but I would tell Bitcoin people this, that all that's happened really is that it went from Bitcoin is exactly the same as it was the whole time. It's just the intermediaries are better now. They're lower cost and they're more trustworthy. So instead of a crypto exchange, you now use an ETF. Either way, you were outsourcing the Bitcoin. So the keys people who want their own Bitcoin, they weren't going to use exchange either. They're going to do it themselves. But for most other people who would have used an exchange, now they can use an ETF, which has multitude more advantages. And so that's all that's happened. The ETFs have effectively disrupted the other intermediaries. So this is an intermediary business disruption situation. Has nothing to do with Bitcoin. It's the same old Bitcoin. So that's all that's happened. And ETFs have a history of doing this. They have disrupted many other areas. They're just so good, easy, cheap, fast. Again, they're like Amazon. Amazon, it would be very difficult to top Amazon in terms of like ease of use. That's why we use it so much. That's what ETFs are like. And so that's why they were so powerful. But the BlackRock and Larry Fink going on TV, those names, sort of tying themselves to Bitcoin is also pretty big, because the advisors of the world who are worried about, upsetting their clients or losing their clients' money, this gives them some air cover and some idea of like, okay, I'm not going on a limb. BlackRock said it's okay. Fidelity says it's okay. They feel safer now. So I can't overstate how huge that is, not to mention all their wholesalers and people who can speak like normal, sort of, I call it boomerese. They can talk about Sharpe ratio and like shareholder value and stuff. Like, this is effectively what's gone down. And so I'm actually working on a book about it. And to me, that's why I think the BlackRock ETF filing was the first minute of the second era of Bitcoin.
All right. So here's a tough question. If Jack Bogle were alive today and looking at Bitcoin ETFs, what would he think? I mean, would he see them as a legitimate asset class deserving ETF access, or a kind of speculation wrapped in just low cost wrapper?
Yeah, no. So Bogle basically did trash Bitcoin before he died, but this was also when Bitcoin was a little more like wild. But he wouldn't have liked Bitcoin. It wouldn't have been personal. He doesn't like gold either. He doesn't like anything without cash flows. There's a whole crowd of people who wants that intrinsic value. Buffett, Bogle, Jamie Dimon, like there's a logic to what they're doing. If you look at assets through the lens of do they have cash flows, Bitcoin sucks. I get it. So I think if I were interviewing him for a fourth time, because a lot of our interviews were contentious because he didn't like ETFs and I'm an ETF guy. So I would throw him all these like scenarios. I would ask him this. I would say, look, understood about wanting stocks, but what about this idea of like currency debasement and wanting to store your value in something that was like permanently scarce? Similarly to the way a rich person would buy a Picasso painting or any like expensive art, an old car, an old baseball card, a bar of gold. These are sort of psychological assets that don't have any cash flows, none of them. But they are a way to buy something that the government cannot debase. So what if we put Bitcoin in that category? Would you at least accept it as a psychological asset that can store value? I think he would say that's okay. But I think what he would probably pivot to is that stocks are inflation hedges, simply because anytime prices go up, they actually help the stock's revenue, and therefore you're going to benefit from the inflation. So I think that's what he would say. But gold is outperforming the S&P since 2004 when the gold ETF came out, and that's pretty powerful. So I would think like if you thought this back when gold came out, you would have won big. And so I feel like Bogle isn't like the end all be all. So he also, by the way, he trashed most of Vanguard's funds. he thought a lot of the funds that even he launched were a distraction and unneeded. So Bogle was savage to everything and everybody. I mean, he was like that ultimate like yell at the clouds grandpa guy, but he was really a great man too. So he got away with it, and he really did have the investor at heart. But I think in the Bitcoin case, I would love to reframe it for him in certain ways, because I do believe if you view Bitcoin as a psychological asset, that's how you can have the Buffett CFA part of your brain coexist with the Bitcoin part of your brain without being in conflict. And that, at least that's what happened for me, because I like both. I understand both. So that's what I think he would say, and that's what I think I would say back. And in the end, I don't know if he would relent again. I think there are probably some people who are just of a certain age where it's too late to actually like change your mind on that. And I just had a note I put out today about how the election in New York City, Zoran, the socialist, that the core driver of his election is the same as Bitcoin: lack of affordability, and this feeling amongst young people that something is being stolen from you. You can't touch it or see it, but you can feel it. And that is the money supply growing, which ends up just drifting right to the top. And if you own stocks and bonds, you're like, this is great because all the asset prices are inflating. But for people who don't, it's like the prices go up, but you don't have this whole chunk of stocks that you own that are like offsetting it. And so all you're left with is the inflation. And then you're like, I can't afford a house. And all of a sudden you're pissed. So I can't, that's what the old people I think need to at least understand. They don't have to buy into Bitcoin, but like you have to respect that. And so this election in New York, I think, might be a way in for people to understand. I'm like, this is the same issue. It's just two different solutions, two very different solutions, trying to address the same exact problem.
We are reaching to the end, but let me just ask two more questions, maybe three. Quick one. You've drawn parallels between tokenizing traditional assets and creating ETFs for crypto. Where do you see this convergence heading? I mean, will tokenization disrupt ETFs in the end, maybe? Or maybe it's quite the opposite, that ETFs are superior upper?
I think ETFs are going to hold off tokenizations for a long time. ETFs are tough. They're as tough as they come. And we've had record launches this year by a lot, like over 1,000 ETFs launching. So issuers clearly aren't seeing anything. And believe me, they want to stay ahead, but they're not seeing anything that says, let's just do tokens instead, because they keep launching ETFs. And the flows are going to break the record. They're going to be 1.4, 1.5 trillion this year. That's unbelievable. That's $4 billion a day in flows. And hard to, so ETFs are in their prime. Now, whether they're peaking, we'll see. But I'm telling you, you can just, I used to say you could roll out of bed. I no longer say that, because I'm like, you could just stay in bed, wake up, you grab your phone, and you can go boom, and then you can own almost anything under the sun, any asset or strategy for almost no fee, right? Very low fee typically, almost no bid-ask spread. And it took 1 to 2 seconds. I mean, I just don't see how that is going to be disrupted anytime soon. To me, tokenization will be taking an ETF, tokenizing it so that people on chain, I don't know if you are, but if you live on chain, we'll get you the TradFi assets in your format. Or if you're in like a developed country and you don't have Schwab accounts, we can get you TradFi assets to you, just like we get stable coins over there. So that's where I think tokenization has benefits. But those two groups have almost no money compared to the big, giant blob of boomer money, mainly in the US, who are just like, you're not going to disrupt that scenario I just said. So I think for a while, until the young people get older and get more money, I just don't think tokenization will disrupt ETFs all too much. Give it like 15 years and we'll talk again.
All right. What's the title of your new book, and when do you plan to finish it?
It's called Both Sides of the Coin, and it's going to come out probably in like next October. Takes a while, but we just finished writing it. So I've been like 8 months deep. I was nervous as hell and anxious about it like 6 weeks ago, but I went wild the last 6 weeks editing it and working out a lot of kinks. And now I'm excited. I can't wait for it to come out. I wish they would move up the release date, because crypto moves so fast that some of this stuff could be, the numbers in particular are going to be dated. So That's my only concern. But the stuff in it, I think, is pretty evergreen, and I think it will help people. I'm just saying to people, I know you got this opinion of crypto or Bitcoin from 2017 or whatever. Take a fresh look, because they're coming to your 401k, whether you like it or not. This is going to be an option in your retirement plan, so you better have at least take another look at it, and see if it's worth it, and make an educated decision, not just one from some anchor bias from 5 years ago. That's my point of the book.
So once your book will be on the market, hopefully we'll have occasion to talk about it.
Yeah, we'll do it again.
Yeah, thank you. Where can our listeners find more of your analysis and stay updated on your latest insights about ETFs and investing? I know you especially from the X, but maybe there are some other places.
Yeah, so if you have a Bloomberg terminal, BI space ETF Go is the function that my research is. Or I do a podcast called Trillions, where you can find it on Spotify or wherever.
I'm listening to it.
There you go. And then I have a TV show on Bloomberg TV, which is on cable or streaming, every Monday at noon, called ETF IQ.
Eric, thank you for this incredibly rich conversation. And, the Bogle Effect wasn't just about lowering fees. It was about fundamentally changing how we think about relationship between investors and markets, between activity and results, between complexity and wisdom. And now we're seeing that same tension play out in crypto ETFs, boomer candy, hot sauce, and the next generation of investment products. So that insight continues to matter today more than ever. Thank you, Eric, once again for joining us on ETF Atlas.
It was my pleasure. Thank you.
Thank you. Bye-bye.